is expected to result in a slowdown. Now, the magnitude of the impact, of course, it's practically impossible for any of us to understand right now how bad the crisis is going to be from an economic standpoint. I think it'll help if everybody mutes their audio.
Can everyone please mute your audios and videos as well, so that we can clearly hear what Dr. Sengupta has to say? Yeah, I think everyone is muted now. We can move on, yes.
The lockdown is lifted. Basically, we don't know what's the duration and what's the severity of the shock going to be in India. We are still at the early stages of the virus transmission. How the lockdown is managed is completely uncertain. We are hearing slowly that some activities will gradually be allowed across different states and districts, but we have no idea how things will pan out in the next 1 or 2 months. And also, once the lockdown is lifted, how the situation will unfold is also uncertain. So amidst so much of uncertainty, it is very difficult for us to assess how severe the economic crisis is going to be. And as I said earlier, while the health shock is temporary in nature, because it will end at some point of time, the economic slowdown may last much longer than that. It could be a year, it could be 2 years, or even longer. We don't know. Now, let's go to the next slide, Homer. Okay, so now I want to talk briefly about what were the economic conditions in India prior to the outbreak. And this is important because in some sense, our position is slightly unique compared to some of the other countries which have been very badly affected by the health crisis, such as the US, the UK, Italy, France, Spain, etc. The reason is because the Indian economy was in a precarious position before the outbreak of the COVID-19. It has not been doing very well. In fact, the economic conditions had worsened significantly while we got hit by this massive shock. The GDP, which is the gross domestic product, or the total output of the country, was growing only at 4.7% in 2019, which was the lowest rate since 2013. Okay, so that's a pretty a grim picture. Unemployment rate was at a 45-year high. That shows how the economic conditions were. Private sector investment had been declining because the private corporate sector had been facing a crisis of its own over the last 5-6 years, as a result of which investment had completely stagnated. In fact, in the last few quarters, investment was going down. Consumption has been falling, which is again, it's happening after many years that consumption expenditure is falling. So overall, India was not doing very well while we got hit by this massive shock. And that makes our situation even more vulnerable as we try to address this crisis. Specifically, there are 3 factors which make India's situation weaker than perhaps many of the other countries. One factor is that India has a very large informal sector, as you guys all know, right? These are basically all the small and micro enterprises, all the shops that you see by the roadside, all the vendors that you'll see, all the construction, daily laborers who are working at construction sites. Okay, so there's a really big informal sector in the country, which does not pay taxes, which does not follow any kind of labor laws. And that informal sector employs close to 90% of the working population. So that's a really, really significant amount and contributes more than 45% to the GDP. The reliance of the Indian economy on such a big informal sector makes us very vulnerable when we are hit by a crisis like the COVID-19, because the informal sector will be disproportionately affected by a countrywide lockdown. Because imagine your own life when you're sitting in the house and all you're essentially buying is food and essential groceries and medicines. All your other activities on a day-to-day basis have come to a halt. That is affecting the informal sector in a massive manner because you are not buying from them, you're not interacting with them in the services sector, and that is very damaging for them because they don't have any social safety net. They don't have most likely a bank account, or they don't have a regular income. So that makes us really vulnerable to a shock like this. The more we withdraw, we meaning the formal sector withdraws in a lockdown, the worse it gets for the informal sector. And this is also important because the informal sector was already struggling from the effect of two shocks earlier. One of them was the demonetization of 2016, when more than 80% of the currency became unusable overnight. And that hit the informal sector very badly because the informal sector largely depends on cash. And the second shock was the goods and services tax. Because of the way it got implemented and the rules started getting changed, that was also another big adjustment and hence disruption for the informal sector. So while they were dealing with the effect of these two shocks already, they got hit by the third shock, which is COVID-19. So it's very difficult for them to survive through this shock. The second point, which makes the situation of India more precarious, is because over the last 5-6 years, there has been a balance sheet crisis in the banking sector and also in the private corporate sector. And you guys must have been reading the news continuously that a non-performing asset, or NPA, in the banking sector has been increasing. Banks are not lending, firms are not investing, because firms have already borrowed so much. They're over leveraged. They borrowed so much from the banks that all they are doing is just basically paying off their debt. And whoever is not able to pay the debt is basically landing up in the insolvency and bankruptcy court because they have defaulted. Okay, so there's a lot of mess going on in the banking and the private corporate sector almost since 2015-16. And as a result of that, banking is one of the most important elements of the financial system in India. We are a heavily bank-dependent economy. So if the banking sector does not work well, that affects us very badly. The private corporate sector is extremely important because they are the ones who invest and create jobs. So to the extent that they have not been investing and they have not been able to manage their finances, that also hurts our employment. So this was already the situation before the COVID-19 shock hit us. And of course, now things will get significantly worse. The third point that makes our situation also a bit unique is that we don't have a lot of policy space left to deal with a crisis of this magnitude. Typically, in macroeconomics, the two policies that we have are fiscal policy, which is where the government adjusts its taxes or its spending, and monetary policy, which is where the central bank, which is the Reserve Bank of India in our case, changes the interest rate and makes it easier or more difficult for us to borrow from the banks. Now, over the last few years, both of these policies have somewhat become ineffective. Our fiscal deficit, which is the difference between how much the government spends and how much the government earns, has already reached very high levels. It's around 3.8% of GDP. And why do I say this is high? Because there is an act which is called the Fiscal Responsibility and Budget Management Act, which is the FRBM, which stipulates what the fiscal deficit should be as a share of GDP. And we have already exceeded that limit for this year. So, for the last budget that was announced. So the fiscal deficit being high means that the government does not have a lot of room to spend money right now to give a fiscal stimulus. Also, we have to keep in mind that because of the lockdown, because of people probably will lose their jobs, incomes will be slashed, there will be a massive shock on the tax revenue of the government from both goods and services tax or both income tax. So while tax revenues start falling, even if the government does not spend anything, the fiscal deficit is bound to increase. So that limits the fiscal space the government has right now. On monetary policy, what is called transmission, that the Reserve Bank of India changes the policy rate, what will be the effect on investment and output? That link in general in India has always been weak for multiple reasons. And at a time when the banking sector has been dealing with NPA problem, the monetary transmission becomes all the more weak because banks are just not interested to lend, and neither is the private corporate sector interested to borrow. So that transmission breaks down. And third is we have fiscal and monetary policies, and we also have some financial lever, and I'll come to that. Okay, so these are the three things which make us unique in some sense as we try to address the COVID crisis. Komal, can we go to the next slide, please? Yeah, so I want to focus a little bit on the banking sector. And the reason is that, as I said, India is a heavily bank dependent economy. Now, all of us have bank accounts. We keep our savings in fixed deposits or other forms with the banks. We take loans from the banks. We are dependent on the banks in a lot of ways, right? And in such an economy where the banking sector plays a critical role, if the banking sector does not function well during a crisis time, then that is very bad, because whatever the policy is being adopted by the authorities, it has to be channelized through the banking sector to some extent to reach households like us, or to reach companies who are interested to invest, who have to survive this crisis. Now, what is happening in the banking sector? What happened was, when the banking sector was going through this NPA crisis since 2015, when non-performing assets had become very, very high, especially in the public sector banks, the authorities, namely the government and the Reserve Bank of India, had to take multiple steps in order to address this crisis. Again, you may have read in the news that the weakest 10 banks were put in something called the Prompt Corrective Action Framework, or the PCA, which means that the banks are not able to expand their books. They have to do severe cutting back of their assets and their books. They cannot lend, which is again damaging for a bank, because at the end of the day, the bank is doing the business. There were several senior bank officials against whom investigations had to be initiated by the CBI, etc. Some senior bank officials even got arrested because of fraudulent transactions, which becomes very demoralizing, as well as it kind of provokes fear amongst bank officers, as you can imagine. And also, the banks were directed to trigger the insolvency and bankruptcy law against many of the firms which had defaulted. So as a result of all of these, and mind you, when the banks are triggering a bankruptcy law against a firm, it is also very damaging for the bank, because the bank has to take what is called a big write-off. It cannot recover the entire amount that it had lent to that firm, and that is a loss for the bank. So the banking sector had been very badly battered by all of these things over the last few years. As a result of which, what happened was that there has been a gradual rise in risk aversion in the banking system. They have become extremely cautious and conservative in their lending decisions, and that risk aversion continues even today. The second thing that happened was, while the NPA crisis was kind of plateauing out by 2018, the entire financial system of the country got hit by another shock, which was the NBFC crisis. As many of you may have heard, a very large NBFC called Infrastructure Leasing and Financial Services, ILFS, defaulted on its debt, despite being well rated by the credit rating agencies. And that sent shockwaves through the banking system as well as the debt market, because this was an unexpected crisis that happened. And as a result of this crisis, in the bond market, the reaction was that the credit spreads, which is essentially what determines the cost of borrowing in the bond market, went up significantly for almost all borrowers, not just financial sector borrowers. And this further aggravated the risk aversion of the banks, because already they were dealing with NPA crisis. Many of the banks had exposure to the NBFCs, that lent to the NBFCs, and banks became even more risk averse because this was a system-wide shock. And this also triggered risk aversion in the debt market, because as you can imagine, NBFCs had borrowed heavily from the bond market or the debt market. And when one NBFC defaulted, the debt market operates largely on sentiment. Entire debt market froze up, and nobody was willing to buy any bonds, or nobody was willing to issue any bonds in the debt market. So that was the situation in 2018-19, which was quite a bad crisis. Now, this was the situation in the banking sector and the debt market. And the result of this risk aversion is basically exactly the next slide, which is slowdown in credit growth. So what happened was that banks particularly the public sector banks, which accounted for close to 90% of the NPAs, severely cut back lending to the private corporate sector, because it was the private corporate sector which was responsible for majority of this NPAs, because they were the ones who had defaulted. So banks basically stopped lending to the companies, to firms. And by financial year 2017, net bank credit, which is credit to all sectors of the economy, was growing at barely a rate of 2.6%, which was the lowest rate in almost 10 years. That gives you an idea of how bad the situation was in the banking sector. By the time it was FY 2018, which was just before the NBFC crisis, the public sector banks were pretty much lending only to NBFCs. They were not lending to the corporate sector at all. And the private sector banks were only lending to retail customers like you and me. So if you would go for an education loan, an auto loan, or a home loan, you were highly likely to get that loan because the retail customers were not facing much of a problem. In fact, private sectors banks went out of their way to make loans to retail customers, but nobody was lending to the private corporate sector. The firms were not getting any loans. And so essentially, then we can skip the next 3 lines because I've already repeated that. So the next slide, we'll have a slide. So Komal, if you go to the next slide. Yeah, the next one. Exactly, this is a graph which shows you the year-on-year credit and deposit growth of the banking sector from April 2019 to Feb 2020, which is just before the coronavirus hit India. As you can see, the blue line shows the annual change in the credit, the bank credit, and this is total non-food credit growth. Okay, so all the bank credit that has been extended to non, and you can see that basically over the last 1 year, there has been a systematic and secular decline in the credit growth of the banking sector. So as we went into this coronavirus crisis, the banking sector basically had stopped lending to, by and large, to the economy, right? And even deposit growth had Let's go to the next slide, Homer. Yeah. So, and what is worth noting is that this decline in credit growth, which has, in fact, this decline in credit growth has been largely responsible for the slowdown in GDP growth that I talked about earlier. This happened despite the fact that the Reserve Bank of India has been lowering the interest rate, right? What is called the policy repo rate, the rate at which banks borrow from the RBI. That has been reduced by as much as 135 basis points in 2019 alone. Okay, that was a really, really sharp reduction in the interest rate done by the RBI in just 1 year. But as you saw in the graph in the previous slide, despite the reduction in the repo rate, even if we lag of a few months, the credit growth in the banking sector has not picked up at all. If anything, it has continued to decline. And this repo rate, by the way, has been the lowest rate in the last 10 years. So this shows that there has been a complete decoupling between the monetary policy done by the RBI and what the bank credit growth has been. Now, of course, one may argue that this credit growth decline has been because of lack of demand from the private corporate sector, because they have not been investing, because they were dealing with their own balance sheet crisis. That's true, and that is partly one of the reasons why banks have not been lending. But the reluctance on the part of the banks has also been a very big factor. As the RBI governor recently said, that in view of subdued profitability and deleveraging by certain corporates, risk-averse banks have shifted their focus away from large infrastructure and industrial loans towards retail loans. Right? This is exactly what I was saying, that because banks were so risk-averse, had become so risk-averse, they were not lending to infrastructure companies or other industries. They were just lending to the retail sector. So let's go to the next slide and I'll show you a graph that further establishes this point. So what you see in the first panel is essentially the growth rate of bank credit, again, from April 2018 to Feb 2020, which is again right before the COVID-19 crisis. And you see that the red line, which is the very last one to axis, that is bank loans to industry, large, medium, micro, and small industries. You'll see that there was a bit of a pickup post August 18, and this was during the NBFC crisis when banks were encouraged to lend to NBFCs in order to deal with the crisis. But pretty much since June 9, 2019, you'll see that the bank credit to industry has been declining and practically went very close to zero by Feb 2020. And what you'll also see is that loans to services, which is the blue line, has also been declining significantly. The one thing that has not declined by much is the purple line. Bank loans to the retail sector, or which are called personal loans, the loans that people like you and I would take. You see the yellow line has gone up in terms of share from 31.9% to 60%. So that shows by how much, and this is just between February 2019 and February 2020. So in just 1 year, the share of retail lending by the banks has simply doubled. And at the cost of share of or lending to industry. You can see the red portion of the bar chart. You'll see that lending to industry, the share of lending to industry has come down from 15% to only 3%. That is a remarkable reduction of lending to industry. And likewise, lending to services has also gone down. What has not changed much is lending to agriculture and allied activities, right? So basically, the two graphs together show you that on one hand, overall bank lending has been declining over the last 1 year very sharply, and especially lending to the corporate sector has been declining. What has only increased is lending to the retail. And I know from the data that primarily this lending to the retail sector is happening through the private sector banks. Now, what does this mean for the COVID-19 crisis? Let's go to the next slide. Komal, let's go to the next slide. Yeah. So in a bit, I will come to what the graphs mean for the current. Like now, hello.
Hello.
Sengupta,
Yes.
come in. Yeah, your voice is breaking. For the last 30 odd
Okay.
seconds,
Is it break? Now
yeah,
is
can
it
you
fine?
repeat for everyone the last 30 odd minutes, 30 odd
Is it
seconds
fine
we missed out your voice. Yeah, it's fine now.
Okay, fine. So I think somebody says, let's see the full slide. So what I was saying is that because the banks have not been lending to the economy, essentially to the private corporate sector, the bond market becomes very important because that's the other alternative avenue through which companies can raise money. But because of the banks' increasing risk aversion, what has happened is that the bond market started getting affected because banks are a very important participant in the bond market. They buy bonds. if they are risk averse and if they stopped buying bonds, then that is again very damaging for the companies. And it is indeed what we see in the data.
Komal, the audio has stopped again, Komal.
Actually, it seems to be the network issue in MEMS end.
Yeah, audio has stopped again. I think there is some issue at the end of Dr. Sengupta.
Shall I try to log back in? Will that help? Because I am able to hear.
No, actually, you're audible right now. We can go ahead. I think we should go ahead right now.
Okay.
Yeah. You're audible, very much audible.
Yeah, I think, maybe it's fluctuating a little bit. Yeah, I guess we
Right.
are just victims of technology at this point of time.
Exactly. That is just.
Yeah, okay. So what I'm saying is that because the bank's holding of non-SLR bonds has declined, that shows that banks are averse to credit risk. What banks have now chosen to do is they are holding more government securities than what they're required to hold under the statutory liquidity ratio, right? Under the SLR of, let's say, 22 to 23%, that's what the banks are required to hold. But they are holding much more than that in terms of GSECs, because they are not holding any other bonds on their portfolio. And that hurts the debt market because one of the biggest participants in the debt market has pretty much disappeared. Komal, let's go to the next slide. So the next slide will show you a graph, which is the non-SLR investment of the banking sector since 2014-15. And as you can see, the blue part of the bar chart is commercial paper or CP, and the orange part is bonds, shares, or debentures. What you see is over the last couple of years, that has come down significantly because basically the banks are not holding any non-SLR bonds at this point of time. They are only holding SLR, and on average, public, private, and foreign banks are holding on average 8% more than what they are required to hold as SLR bonds, which is government securities. Okay, so that indicates extreme risk aversion on part of the banks because they are just not willing to take any credit risk on their books. So in that, what we'll see is broad of, yeah, go to the next slide. Can we go to the next slide? Yeah. So what I've done is I've outlined the broad points of macroeconomic because that itself will take up. But and most of you will already understand this because if you're reading news and keeping track of the events, this is exactly what's going on. So moving away from that focus on the banking sector and the debt market, what's happening now in the macroeconomy is the countrywide lockdown has brought all economic activity to an abrupt halt. Sandeep, just a question. How much time do I have?
Komal, can you let me know? Komal? I think we have 20 minutes. We do have 20 minutes to end this session and we can again begin with another.
Yes, sir.
Okay, great. Okay, so the countrywide lockdown has brought all economic activities to an abrupt halt, right, as I was mentioning. This is, first of all, a massive demand shock, as you can imagine. Hello?
Yeah, sorry to interrupt, ma'am. We have 10 minutes left with this session. Means we can reconnect after that.
Okay, fine. That's what I wanted to know. Thanks. So this is a massive demand shock, right? And as you can imagine, I mean, just think of your own life, how many expenditures you are not indulging in, and you are only focusing on the essential expenditures, which and imagine multiply that by the entire country level. That's a massive shock to expenditure all over the country, which has not happened in God knows how many years, right? So many decades. And this kind of a demand is unlikely to get restored, even when the lockdown gets lifted in the next several months, especially demand for non-essential goods and services, because it's a very unpredictable health crisis. We don't know how to deal with it. We are all going to be careful. We're going to be cautious. We'll not go to movie halls. We'll probably not travel. We'll not go to shopping malls to purchase. I've already stopped the video, so hopefully that will enhance the audio quality.
Yeah, I think so.
Yeah, so essentially we are all going to be postponing our non-essential purchases, and that's why demand is not going to get restored in the next several months, even if the health crisis comes to an end. Three major components of demand, which are consumption, investment, and exports, will probably stay subdued for a very long period of time, right? So consumption, again, as I said, households are going to be postponing consumption expenditures for quite some time. There's an uncertainty. We don't know whether we are going to lose our jobs, whether our salaries are going to be cut, whether it is safe to step outside. Multiple uncertain factors. Consumption demand will get affected. Investment, definitely. Firms are in no position right now to invest in a new plant or a new factory, given the massive uncertainty in the economic scenario. Exports, definitely, because international trade is going to get very badly affected, because all countries are now dealing with the domestic problems. Nobody will really want to engage a lot in international trade. So this is the demand shock, which is immediately happening as we speak. The other thing which is also happening is very big supply disruption, right? So there is a massive supply chain disruption that is happening in India, because raw materials are not available because of the mobility restrictions. Trucks cannot move across states. Millions of migrant workers have gone from the urban areas and have gone back to native villages. There is global trade related problems, so we are not being able to import raw materials. There is restrictions on travel by countries within the country itself, within India. So the supply chain disruption is also very big. And at this point, it's in fact difficult to say which is a bigger shock. Is the demand shock bigger than the supply, or the other way around? But what we do know is that Indian economy has been hit by both the supply and the demand shock, which makes it even more difficult to address the crisis, because typically all our policies are designed to deal with the demand shock. But to deal with the twin shock of demand and supply is, again, an unprecedented challenge. The longer the crisis lasts, the more difficult it will be for many firms to stay afloat. So imagine right now there are firms which have some amount of cash and they're able to survive for the next 1 month, but they have no revenues whatsoever because you guys are not making any purchases. So these firms are not getting any revenue. And very soon they'll run out of the cash that they have. At that point, they will be forced to shut down because they cannot pay their employees, they cannot pay the rent, they cannot pay the banks. So they will default and they will have to shut down. There are many, many firms which are on this borderline between being able to survive now, but may not have cash to last for the next 2 months. And at this point, it is important for the banks to support them, because without the credit support, the firms will basically stop working and unemployment will shoot up even more. And as I said, because of all of these factors playing simultaneously, there will be a significant effect on investment, employment, income, and of course, aggregate growth rate of the economy, right? So it is very difficult to forecast, to predict what the GDP growth rate will be next quarter or the quarter after that, right? So everything is uncertain. But what we can definitely get a sense of is that there will definitely be a very, very big and long slowdown and downturn. Komal, let's go to the next slide.
Well, I think we should have a break right now because we are having 3 minutes left. So we may join in again.
Just go through let me go through the next 2 slides and then we'll break, because then I can just finish the flow and then I can start taking questions.
Right. That's okay, completely.
Yeah. So what the RBI, and I want to focus on the policy initiatives announced by the Reserve Bank of India, because like I said, in the interest of time, it's very difficult to focus on everything that has been announced. And the government actually hasn't announced a lot till now. What the RBI has announced is on March 27th, the RBI announced several initiatives following an unscheduled MPC meeting. MPC is Monetary Policy Committee, which is the committee that decides interest rates today in India. What the RBI decided was that they cut the interest rates. Specifically, they cut the reverse repo rate, which is the rate at which banks park their money with the RBI. Banks sort of lend money to RBI at the reverse repo rate. By now, and the RBI cut the rate again yesterday. So now the reverse repo rate has been cut to 3.75%, which is very low indeed. RBI also announced multiple initiatives to inject liquidity in the banking system. And RBI said that there will be a moratorium of 3 months on all loan payments. And non-performing asset, which earlier was declared if a loan was not paid for 90 days, will now be declared if the loan is not paid for 180 days. So the RBI is giving a lot of these palliative measures in order to give some kind of a relief to the private corporate sector as well as to the households. So I think we can stop at this point, and
Sure.
I can cover the next few slides after we come back from the break.
Right, definitely. So it's 8:25 with me. So we can join again at 8:27 precisely.
Sure.
Sure. Thank you.
Thank
you. Everyone, please keep your questions with you. We would have it in the second half.